Good morning, everyone. I want to welcome you and wish everyone a very pleasant good morning to you, wherever you are. I'm Julie Arthur. I'm the CASH Chair. I'm also the Executive Director of Facilities, Planning, and Development for Palm Springs Unified School District. First and foremost, I hope that you and your families are safe and well during this COVID-19 pandemic. CASH has been providing you with weekly webinars to ensure that we serve our members with the latest and best information to help school districts and county offices of education support clean, healthy, safe facilities for our students, parents, and teachers when they return to school. Last week, CASH presented its 5th webinar on construction climate under the governor's orders, contractor, subcontractor workforce supplies, and PPE availability. For a recording and the answers prepared from the questions asked during this webinar, please visit the CASH website and click on the COVID-19 link to see this info and more links to access the pertinent information on there. Over the past 5 weeks, it's become even more apparent that public schools are an extremely vital component in keeping the U.S. economy strong. Today is the 6th in our series of webinars titled Anticipating Federal COVID-19 Assistance, State Budget Challenges, and the Economy. Our experts will discuss the federal perspective on public education and can we expect the feds to help and what those actions might look like. I think we would all like to know how much in aid the California schools will be receiving and what our California state budget and district budgets might look like. Then we follow up with national, state, and local economy outlook and economic data points that affect municipal bonds. On the screen here this morning, we've got Jeff Becker, and Jeff is the CASH Vice Chair and Fresno County Superintendent of Schools Office. Good morning, Jeff. Did you bring your crystal ball this morning to help with the May revise and budgeting forecast?
Good morning, Julie. I wish I had that crystal ball. It certainly is an interesting time to.
How are things going in Fresno?
Pandemic. Well, it was an interesting week so far. You know, we had, for the first time, a conversation about what it looks like to reopen our schools, right? We heard the governor's comments earlier this week with the 4 stages of reopening and schools being a part of that. So our office is working really hard and quickly with that earlier date suggested of what mitigation measures schools need to have in place and what are just all the inputs into doing that. So in Fresno County, we have a large digital divide with some of our rural school districts that have very minimal internet service. So we're trying to also take advantage of this crisis in that regard and get some leverage and momentum to closing that digital divide. So, you know, some exciting things are happening this week. And at the same time, we are trying to balance all of that in the context of really serious financial concerns about the budget. So, you know, my experience is when we go through crises and difficult times, you know, in that crisis, there's a big push to spend money and do a lot of things quickly. At the same time, we're trying to balance that and be a resource for our school districts. So a really interesting time right now to have a bit of that hope and see that. But we're also very, very cautious financially right now.
Yeah. We went the opposite way in Riverside County. Last night, the County Public Office of Health has issued an amended decree where we will be until June 19th still pretty much closed down, face masks everywhere. So we were hoping, of course, to maybe do a little bit more, get some gyms back open, some reality back into our lives about the first week of May, but they found that it would be much wiser for Riverside County due to the amount of, we have victims here, that it is smart to stay until June 19th. So I don't know how that June 19th will work with the governor's idea of July, but we'll figure it out just like everything else.
Yeah, we'll hope for the best and plan for the worst. I think we've all said that in the past month or two for sure.
Yeah.
Well, let me cover a few housekeeping items and then we can jump into our presentation. So first of all, to our attendees, welcome. We found the Zoom platform this time, which is a little bit different. Your questions throughout the presentation. And the way that we'll do that is through the chat feature in Zoom. So make sure you're using the chat feature, not the Q&A feature. The chat feature is much easier to monitor. So you can put the chat box on your screen. As you're typing in your questions, the drop-down caret in the to field has an option to message all panelists and attendees. And that's the to address that we will use for today's webinar. So make sure that you're using that in the chat box. Also, after each presentation, Dr. Duffy, Ian Padilla, Julie, and myself may interject a few questions as time allows from that chat box. And at the end of the session today, we also have some time for a broader discussion of those as well. And finally, as Julie mentioned, the webinar is being recorded and made available on the CASH website. So if you know folks that were unable to join us live, you can certainly reference it later there as well.
So Jeff,
Yes.
it seems like my technical problems have been resolved.
Oh, hey, welcome, Dave. Well, very timely of you to join us, Dave. Why don't you jump in and share with us your perspectives on the state budget situation?
Thank you. First of all, as Jeff was saying, it is a very uncertain time. And so we'll go to the first slide. That is on, kind of stating the obvious. It seems like every day something new happens, in that we can cram a whole week of information into one day. But just as a very fast, anybody who can tell you what the true state financial picture is right now is either somebody who is making a killing in the stock market or somebody who may be exaggerating their knowledge. There's been a significant drop, but we just don't know how much. The system of how unemployment is being calculated, we have applications, but unemployment payments are not going out. So there's a lot of what I would call lag in being able to do a reasonable analysis of just where we are today, much less be making a projection of going out into the future. So if we could go to the next slide. Essentially, we are trying to have a normal budgetary process. The governor was clear on that. Department of Finance has been clear on that. So they will do a May revision, which by statute must be provided no later than May 14th. So the expectation is there'll be a May revision in less than 2 weeks. That will be essentially what's called a baseline budget, which is what did you get last year? That's what you get this year. It will not be a budget that is based on reality. So we'll be going through a process of having hearings. Each budget subcommittee will be allowed one hearing, and then the full committee will have one hearing, and then there will be a floor vote, and it will pass by no later than June 15th. Governor will sign it. There will undoubtedly be a series of trailer bills, which might be a whole bunch more interesting than the fiscal provisions of the May revision, because the trailer bills will give you a much better idea of the policy discussions going forward. So we'll have that, governor will sign. Then we will probably expect that once they have their real revenue numbers that normally come in from the April 15th deadline, the new deadline is July 15th. Consequently, they won't even know what last year's money was until probably somewhere in very late July. The expectation is everybody comes back then in August. And in August, they'll take a cut at where they are and try to do a budget and then make whatever adjustments are necessary come January. The legislature does not adjourn sine die until November 30th. So theoretically, there could be a second cut as more information becomes available between the 1st of August and the 1st of January. There are a lot of unknowns. If we can go to the next slide. So to give some sort of setting, what's the bad news? Well, bad news is we don't have a guaranteed treatment. We don't have a vaccine. The governor is very clear, and I think most of the people who are listening to this webinar feel the same way. We don't want to all of a sudden come out of where we are right now and then in 3 weeks drop back in with a new surge. So everything is going to depend upon that 4-step that Jeff was talking about of how fast do we go from step 1 to step 2 to step 3. I have no expectation we'll see step 4 for a long time. So how fast do we progress through those? And that will give you an idea of what the economic outcomes will be and what the budget will look like. So what is prudent budget meaning? I won't read it, you all know it. When you're dealing with the state, you don't count money until it's in the bank and cleared. So everybody who should be doing some very, very pessimistic and conservative development of the school district budget, all things being equal at this point, unless there is something making a radical change, and the latest treatment is not, it's a very positive change, but it is not a truly radical change. We will be in this. If we can go to the next slide. So if there is good news, because essentially federal government has done stimulus at $3 trillion, which is a lot more than was done for the Great Recession. And it looks like there's probably going to be more. It's, stimulus 4 has already been done, so we're looking at stimulus 5, stimulus 6. Bob will be talking about that in his presentation after mine. But already the stabilization, the attempt to stabilize the economy is occurring. I'm not sure if you picked up on the unemployment numbers that came out today. Over 3 million new unemployment files claimed, but that is declining, meaning we did 10, then we did 6, then we did 4, now we're at 3. Yes, it's painful, but it appears that the rate of pain and bottoming is beginning to be visible as different states and others begin to try to figure out how to loosen and get out. We had a rainy day fund, so that we didn't have that last time. We're getting a variety of other things. If we can go to the next slide. So we are well positioned for a recovery once it becomes possible to have a recovery. We do not know yet where we are, but if I were to, well, it's 14 days. Why speculate? Why should I become the fool in trying to guess and speculate? But essentially, we are in much better shape for this economic downturn. And the reasons for this economic downturn are such that once those reasons are gone, it's not like the crash of 2008 and 2009 where the reasons continued on. Once the reasons are gone, you can have a good recovery. Until then, we can have a partial recovery. Doesn't mean there won't be pain, doesn't mean there won't be cuts, doesn't mean you won't be deficits. Doesn't mean schools will not have less money between years and potentially significant less. But unlike the Great Recession, it should not drag on for multiple years. So as strange as this may sound, there's a lot of bad news and it will be painful, but we have more good news this time than we had last time. So with that, I'm more than pleased to answer any questions anybody might have if they've been sending things in by chat. And we definitely will send you updates as fast as we can. Once the May revision goes through and once you start seeing some of the legislative reaction and we get more clarity from the Department of Finance and the governor on the real fiscal situation.
David, it's Tom Duffy. I appreciate you taking us through the California fiscal circumstances and the budget process that we're expecting. School districts have requirements to adopt budgets as well by the end of June, as you know. Has there been any discussion of pushing that back for school districts because of the challenges that districts are dealing with today?
To the best of my knowledge, no. That may come up once we see the May revision, and it may be part of that, but it's definitely not something that's been signaled early. They may decide to just say, well, use the May revision for your budgeting and then adjust in August, which schools really can't do. So then everybody will have to start making some decisions. It would be convenient because they have been trying to change deadlines for them to change that one and push it off. But even with that, staffing decisions and other types of decisions are going to have to be probably made over the summer. And I'm not sure how much further out or how much better clarity they can give us prior to the districts having to make those. They may be able to provide a little more clarity if there's a stimulus, but they'll definitely be able to give how much of the rainy day fund are they going to use to try to carry through 2021. And I would hope that'd be a significant part of the May revision. There was a question on stimulus because the governor has his advisory committee of 80, which will have 16 subcommittees to look at stimulus. We are hoping and pushing to do stimulus in a variety of different ways. One is sell all the Prop 51, which get more people in construction working, more money in the system, floating through the system, and reduce the some of the economic hits. Those types of things. They have not been clear on the stimulus, but the governor has supported going big on a school bond. So we're hoping he'll go big on the types of things he might be able to do, and the state might be able to do as a stimulus type of action. I didn't see some of the other chats questions. My apologies.
Thank you, Dave.
All right, next up, we've got a more anxious view from the Washington, D.C. lobbyists. We've got Bob Canavan from Federal Management Strategies, Inc. He's going to talk about federal assistance for K-12 schools and the impact of D.C. dysfunction on public education.
Thank
Welcome,
you very
Bob.
much for the, yes.
Welcome.
Thank you for the introduction. And I do want to just commend everyone in California for how you are all continuing to deliver programs and services to students. It's an incredible situation that you're in. And I would like to, comment that people automatically assume that schools are closed, but the important thing is services are still being delivered for students by school districts, teachers, staff, Lunches are being provided to students and services are being provided all across the state. And that is an important point, and I just want to say it's incredible how all of you are doing that. So my commendation to you, and I want to talk to you about what's going on in Washington. There's a lot of activity that has been taking place about trying to develop solutions. We can move past this first slide to the next one. And what you have in front of you right now is a list of legislation that has been passed by Congress and signed by the president. I'll run through these very quickly, and then I'll talk about some of the key ones which do provide some specific funding, which will be very important because there is specific funding in the pipeline coming to California. The first of the bills that was passed was the Preparedness and Response Supplemental Act, and the second was the Family Response Act, and the third, the most important one, in my opinion, so far, is the CARES Act, which has provided $2.2 trillion in aid, relief, and economic security. The fourth, which was just passed last week, was the Paycheck Protection Program and Health Care Enhancement Act, which provided $483 billion for COVID aid, focusing on aid to small business, hospitals, and funding for COVID testing. There was a very strong effort on the part of Democratic leaders to provide funding for state and local governments in that package, but that was not included. That leads us to where we will be in the immediate future, which is the next COVID aid package, which will probably be referred to as AIDS CARES 2. And those negotiations are very much going to center on aid to state and local governments, schools, and potentially, possibly infrastructure. And that is critically important. This package is going to be critically important. If we could move to the next slide, we'll be talking about the CARES Act itself. The CARES Act was the first economic aid package that passed that actually put benefits in the pipeline, which included unemployment benefits, SBA payroll protection loans, and other programs. And as you all know, the SBA payroll protection loans went out very quickly, and the funding for it was expired within 2 weeks. And obviously, there's a lot of controversy about where some of those loans went. But also included in this package was funding for education. The Department of Education received $30.9 billion under this act. And within that, California should be receiving approximately 11 to 12% of that funding. Specifically, the funding within the CARES Act that will be coming to California is specifically within two sections of that legislation. One is the state grant for governors in the emergency education relief section. Within that section, California will be receiving $354 million, which is approximately 12%. That funding should be in the pipeline already to California. The second section is the elementary and secondary school emergency relief funding. And under that section, California should be receiving $1.6 billion. Of that $1.6 billion, the state is required to send 90% of that to local education agencies. So local education agencies in California should be receiving approximately $1.4 billion to be distributed under the Title I formula, through the Title I formula process. Of that 1.6 total billion dollars going into the state of California through the CARES Act, the state can retain $164 million at the state level for state emergency use to be determined by the governor or the Department of Education. The state can also hold $8 million for administrative purposes, but 90% of that funding should be and must be going to the LEAs. One other thing I want to also highlight, not within the Department of Education, but also related to services that you are very interested in at the Department of Health and Human Services, the $3.5 billion is funded for the Child Care Development Block Grant, which is preschool. And also the Head Start program, which also is, the Head Start preschool program is receiving $750 million. So California should be receiving approximately 12% of those funds as well. So that also should be in the pipeline as well to California. If we could move to the next slide. These next two slides is a very long list of allowable purposes for which these funds can be used. And basically what they're doing is they're loosening, making it a lot more flexible for how the LEAs can use this money. But generally, the funds can be used for ESEA, IDEA, Perkins Program, the McKinney Act for homeless students, and also for adult ed. And they also can be used to coordinate LEA preparedness and response connections that you may be making with public health agencies. You also can, obviously, there'll be funding that would be provided for principals and school leaders for use in particular schools. And another item, which is number 3 on this list, providing principals and school leaders necessary resources for the needs of the schools. And they specify it should be used for addressing the needs of low-income children, students, children with disabilities, English learners, racial and ethnic minorities, students experience homelessness, foster care youth, and outreach services and delivery services. That's an important point. If we could go to the next slide, please. Training and professional development for LEA staff on sanitation and minimizing infectious diseases, purchasing supplies to sanitize and clean LEA facilities and buildings, planning, coordinating long-term closures, providing meals to eligible students, providing technology for online learning and students. And I know that is one of the most critical things that school districts have been focusing on, and how to carry out the requirements of IDEA, which is a huge issue in every school district. Item number 9 talks about purchasing educational technology, including hardware and software, connectivity, and also purchasing of assistive technology and adaptive equipment. All of these are allowable usage of this additional funding. Providing mental health services, and also, and since I understand the governor gave everybody the news that schools may be opening in July yesterday, which I know was news to everyone. But these funds that you're receiving under this CARES Act can be used to implement activities related to summer learning and supplemental after-school programs. So this $1.4 billion that will be going to the LEAs is intended to be used, and to be used with a great degree of flexibility, providing some degree of flexibility and decision-making latitude for people at the local level. I understand, and you more than I know, that that's not going to make up for the cost that you're undergoing, but it is putting some additional federal funding into the pipeline. So that's money that is in the pipeline right now, coming from the federal government to California, to the SEA, and to the local school districts. If we can move to the last slide, please. And now we're at the point where we're talking about what's next. And what's next is a big one, and there could be an additional one after that. But the next one is the Congress is supposed to come back into session next week on May 4th, both the House and the Senate. But the situation is, as of yesterday, the House Majority Leader, Steny Hoyer, announced that the House will not be coming back into session based on the House, a recommendation of the House physician saying it's not safe for members to be back in full session. Now, there may be committees coming back for hearings, but the House itself will not be in full session. The Senate is still scheduled to come back on Tuesday of next week. The situation is, this is going to complicate the development of the next package, because the next package, the number one item that's on the table for the next package is aid for states and local governments, municipalities, and within that, education groups in DC and members of Congress are saying schools, aid to education should be part of that package. And there has been talk about infrastructure, including school infrastructure, should be part of that package as well. Now that's the point of view of Democratic leaders. Republican leaders aren't quite as much on board. As a matter of fact, you all heard last week, I'm sure, or the week before, when Majority Leader McConnell in the Senate said, well, maybe states should consider filing for bankruptcy. There's been a pretty large, strong backlash to that remark. Since then, he's pulled back on it, and that his pulling back on that is probably an indication that he's probably a little bit more willing to talk about aid to state and local government. And this week, he's saying infrastructure should not be part of this package. But very definitely, this package is going to be talking about aid to state and local government. Speaker Pelosi was on the news this morning, one of the early morning talk shows this morning, and very emphatically was saying how important this aid is to states, local governments, municipalities, schools, to provide for aid to deal with this pandemic. It's not making up for mistakes made previously. McConnell had made the remark, we're not going to bail states out for their pension plans. The speaker very clearly said, this is to deal with this pandemic. And that's what this is all about. But these negotiations are going to be pretty intense. And so that's why the House not being in session next week is going to change things somewhat. It'd be better if they were in session and if they were here. But I think we're going to see the House very definitely wanting to take the lead in pulling this package together. And it's important that they do, and that it become a House bill. Because if the House writes the bill first, it's going to be written with their perspective and putting the aid to state, local government, and schools in a much stronger position than if it's written from the Senate perspective. Now, on the infrastructure side, the leader, the speaker has said over and over again, she wants schools to be part of any infrastructure package. So if somehow schools are in this, if infrastructure comes in this package, schools would be in it. If infrastructure is held out to another package, then schools will be in that package. But school infrastructure is very much on the table for whatever infrastructure package is put together. And the major piece of legislation that focuses on how can we provide an assistance for school facilities and create jobs, as David was alluding to that, how important it is when you're building schools, renovating, repairing schools, you are creating jobs in local communities and you are stimulating your local economy. Well, this Rebuild America Schools Act provides grants and tax credit bonds to finance school facilities. And so that's the important argument for the Rebuild America Schools Act. It does it both through grants and tax credit bonds. It revives the qualified zone academy bond program, which California used so successfully. It improves the program actually by eliminating the private contribution. It allows for the building of new schools. It creates a new bond called the Qualified School Infrastructure Bond, which actually is, you used it previously. It used to be called the Qualified School Construction Bond, but it's now called the Qualified School Infrastructure Bond with a new name, but it would create $30 billion worth of those bonds. It also has funding for high-speed broadband, and that is one of the critical issues that many of your school districts are facing as they try to do their distance education. It's interesting how hotspots have become more expensive all of a sudden in many of your communities. Why is that? Well, is it a profit motive? We hope not, but it certainly seems to be. Other provisions that could be out there as the tax committees look at this would bringing back Build America bonds, reinstituting advanced funding to assist with the financing of bonds, energy generation and storage facilities. There are a lot of possibilities, but all of that still needs to evolve. And in summarizing, at least on this next package, the most critical aspect of this is that the impetus for aid to state and local governments, municipalities, and schools is the reality that the budgets that are, as you alluded to this in David's conversation, budgets are being put together. You're dealing with the crisis, you're dealing with current budgets, you're dealing with the budgets for the previous years, and you're dealing with the huge holes in those existing budgets created by this health crisis. So there needs to be more federal assistance, just as there is for the airlines. Now they're talking about aid for the oil industry. They're talking about for the restaurant industry. Well, schools aren't called an industry, but it certainly is an investment in the United States of America. So that is why this next funding package is so critical. And I think you're going to see certainly the Speaker of the House fighting for that extremely hard, the House of Representatives fighting for that extremely hard, and a really strong push for that. That is what will be playing out over the next couple of weeks. And so I'll conclude by saying that there is funding in the pipeline for California in the form of education aid. It's nowhere near the need that you do deserve and should be receiving, but at least there's over $1 billion that's coming through the CARES package, and hopefully there will be more. And I'll respond to questions that come later on. And thank you, and I appreciate the opportunity to talk to everybody.
Wow, Bob, that was a lot.
I am sorry, I know that was a lot.
No, is wonderful. A great information. My gosh, having some of these bullet points of what it's going to take care of. One thing that I had a question on is our governor is mentioning that if we return to school, whether it be July, August, or September, we may have to have a limited number of students in the classrooms. I can't imagine any school district that has half its portable or classroom inventory available to do that much separation. You see any help with the federal on that? Or Dave, do you see with the state? How do you see that roll out? I just can't put 10 kids in.
I don't see it rolling out well. The different issues that are out there, I think you've seen already on doing split sessions or doing what I call platooning. All of that has costs. And to keep social distancing, it might be easier than we think if parents do not believe it's safe for their kids to come back to school. And to the best of my knowledge, nobody has really spent a lot of time consulting with parents on what is it they want to be absolutely assured of and guaranteed in the funding to the schools to make sure those assurances and guarantees can be met prior to having their student return. So there are a lot of different questions regardless of the state start date. Almost all of them are related to, do we have enough money available up front to take the necessary actions? However whatever the local community finally decides is in the best interest of the school district and community, and the parents are supporting. We have a timing issue, and that was one of the things I'll turn it over to Bob on, but not a lot of districts have a lot of, you may look like a lot in percentage terms, but a lot of money for large capital expenses in a very short period.
No, absolutely. And so one step out of the classroom is, how do I bus these students in a bus with social distancing?
Well, I don't know how you do that.
Yeah, I mean, even so, the amount of work, even with split days, the amount of work to actually come in and sanitize the classroom for the second set of students coming in is going to take time. Same with the bus. I mean,
Right.
how do we?
Yeah, and it's not just one and done on the sanitation. It's going to essentially have to be done every night or every switch.
Yeah, absolutely. Well, I'll tell you what, let's go ahead and move on, and we'll have some of these questions. We'll have everyone hop back on at the end and have some of these questions kind of answered a little bit. So next up, we've got Erica Gonzalez and Marcus Peters. They're with Stiefel, Nicholas and Company, and they're going to talk about a perspective on the national economy, the impact of unemployment, the cloister consumer, and the infrequent traveler. Erica, are you up there?
Great. Julie, this is Marcus Peters. Can you hear me?
I can. Welcome.
Great. Thank you. I think Erica was having some connection issues. So over the next two slides, just going to kind of give a brief indication of, how the economy was doing, how it's doing now, and then kind of how that is impacting municipal finance. So if we could turn to the next slide, I think it's an important perspective really to kind of look at where the economy was prior to the coronavirus. Well, that will give us a good sense of where it's going and what we can really expect, I think, for the next several months and going into 2021. So as we can see here on the slide, the economy prior to the coronavirus was doing exceptionally well. The top graph here shows a graph of the S&P 500 in 2019. Stocks had an absolutely amazing year, returning about 30% for that index. So a really banner year for the equity markets. Major trade themes or major markets themes of 2019 was really the completion of the phase one trade deal with China. This really gave a lot of steam to the equity markets in the latter half of the year once everyone believed that deal was going to get signed. And then, of course, in the fourth quarter of 2019, when it did in fact get signed, that moved significantly higher. Also of last year, I'd say major kind of economic themes were really U.S. monetary policy. The Fed lowered interest rates 3 times throughout 2019. and ended at about a 1.5% federal funds rate, which is exceptionally low. I'd say most of that tightening throughout 2019 was really in response to the trade war that was in the beginning of the year and spilled over into the second quarter of 2019. So it's really kind of to combat the negative side effects of the trade war with China. Also, as it relates to the actual economic data in 2019, we had some pretty staggeringly good figures. Record low unemployment. Unemployment rate reached 3.5% by the end of the year. Very strong job growth. We were adding about 200,000 jobs per month going back to 2015. So I would say when economists look at the pace of job growth, I'd say a robust economy is one that's adding at least 200,000 jobs per month. And that's what we really saw since the end of the Great Recession in 2009. And combined with that, we had a very low inflation rate environment. The Fed's preferred measure of inflation, the Personal Consumption Expenditures Index, remained below 2% for the entire year. This really driven by obviously low oil prices that kept the headline inflation number significantly lower. And then really looking at the bottom left-hand graph, I think this is a very insightful graph here. You can see it's just a solid bar. So really since 2015 to 2020, we saw jobless claims. This is a number that's reported weekly, that is people filing for unemployment claims, range between 200,000 and 300,000. I mean, consistently, week after week, from 2015 to March of 2020. So it's been a really robust recovery since the last recession. And we'll talk about this a little bit more on the next slide. And then finally on this last graph here, the bottom right-hand graph, we can really see what's happened to interest rates. So the borrowing rate for the 30-year MMD, which is the municipal bond borrowing rate, and the U.S. Treasury rate, typically, as you can see here from this graph, remained very much in sync, trending lower throughout most of 2019 as investors flock to safe haven assets such as municipal bonds and U.S. Treasuries. But again, very correlated, that is municipal bonds to U.S. Treasuries. So now as we turn to the next slide in what happened after the coronavirus, we can see some pretty drastic changes. First of all, the S&P 500 or the equity markets reacted pretty strongly, although I would say definitely a little bit delayed. The coronavirus news really broke in January and into February, and we didn't see much reaction while the virus contained mostly in Wuhan. Now, as soon as we start seeing the virus spread to Italy and other major European countries, that's when our markets here, as a result from the S&P 500, really took a nosedive. And we saw just in a period of 4 days, the S&P 500 reduced or erased about 33%. So a significant drop, entering a bear market. Since then, we have seen about a 29% increase. But really, the impacts of the coronavirus, that is the shutdowns and closures of borders, the unprecedented market volatility, the slowdown in the housing market, and of course, consumer confidence, have all taken a pretty significant hit. You can see here on the bottom left graph, as we look at jobless claims, during the first 5 weeks after kind of the government shutdowns here in the United States, we saw 26 million people file claims. And then following that, we just had reported this week of another 3.8 million. So that brings the 6-week total to over 30 million Americans filing for unemployment claims. And so it's obviously a very drastic move lower. We're likely to see a very drastic move higher in the actual unemployment rate. Economists are currently projecting about a 16 to 20% unemployment rate for the month of April. That's up from about 4.4% that we saw in March. So it's going to be, in terms of the actual magnitude of the employment situation, it's going to be significantly worse than 2009 or the Great Recession, where we reached a high unemployment rate of 10%. Now, how is this impacting the municipal market? Well, you can see here on this bottom right graph that, as soon as we saw in the I'd say, first 2 to 3 weeks in March, we saw a panic in U.S. financial markets, and investors really shift from those safe haven assets to the safest assets in U.S. Treasuries and cash. And so we had a really drastic sell-off in municipal bonds, where investors were selling their municipal bonds to move to cash and treasuries. This really caused interest rates in the municipal bond market to spike, reaching a 30-year rate of a 3.37%. That's up about 1.6% from just 2 weeks prior to that. So it was a very, very abrupt move higher in interest rates. The new issue market for municipal bonds seized up with very, very few bonds pricing in the market. But the good news is, after all this, we have seen a return to normalcy in the municipal bond market. Rates have come down. That 3.37% 30-year borrowing rate is now about 2.3%. So we've come down off those highs. The municipal bond market is functioning with more and more supply, new issue supply coming to market, and borrowers are not effectively sitting on the sidelines anymore. So I'd say, despite the turmoil that we saw in March and early April, we are returning to somewhat more of a normal market. Now, we'll likely continue to see some volatility in the municipal bond market, but as Bob has mentioned, the CARES Act, combined with some of the stimulus measures that the Fed has introduced, I think will keep our market stable for some time. And with that, I will turn it over to Erica if she has managed to reconnect.
I am reconnected. Thanks, Marcus, for your overview. And Marcus and I work alongside each other in our San Francisco office when under more normal circumstances. I'm working from home currently, and Marcus is still at our trading and underwriting desk in San Francisco, and he follows a lot of the market economic indicators and geopolitical news that he's been describing, as well as certain Twitter feeds as well, pretty closely. And he helps bring to market about 100 K-12 transactions for California school districts that we work with here at Stifel. And so if we turn to the next slide, what I wanted to do was put things a bit into perspective. We work with many school districts throughout the state on evaluating their bond programs and their capital facilities needs amidst this sort of economic and market dynamics that we're currently living under. And I thought looking at this case study for a specific school district that we're working with would be insightful. This school district was successful in passing a bond election in 2016, along with many other school districts, and they've been successfully moving forward with their bond program, issuing bonds in 2017 and 2018, and now here we are in 2020 as they continue to move forward on modernization projects and other projects at their district to issue the next tranche of bonds for their program. And as we took a look at, where they had accessed the market at different points throughout their program, it was pretty insightful to see that while we're in the midst of this pandemic and a lot of uncertainty with regards to the economy and how the economy will continue to recover and how that's affecting school districts throughout the state, we've mapped out here for this school district what interest cost they paid for on their previous bonds. And interestingly, we're projecting that the interest rate will actually be lower for this tranche of bonds than it has been for their last 2 series of bonds. And if we move to the next slide, I think that really provides that perspective in terms of interest rates. So this goes back, shows a general obligation bond index published by the bond buyer on a weekly basis, and this goes back to 2015. And if we look at sort of the interest rates movements up and down, we've put flags here for Brexit in 2016, where we saw a sharp decline in interest rates after that announcement. The presidential election in 2016, we saw a spike in interest rates after that, as there was an expectation for more business-friendly policies coming out of Washington after that election. And we see where the Series A bonds were priced in March of 2017 for this school district. And as we move forward through 2017, end of 2017, we saw tax reform get enacted again, more corporate-friendly provisions that would stimulate the economy. We see interest rates continue to rise. The district brings its Series B bonds in May of 2018. And since then, we saw rates continue to rise, but throughout 2019, we have enjoyed having interest rates continuing to decline and decrease. And while we are in the midst of the coronavirus outbreak, we have seen that volatility that Marcus describes, but even with that volatility and spike in interest rates, we're well below the average interest rates that we've seen over the past 5 years. And the average over this period is about a 3.5%. Currently, this index is at a 286. The low point was actually reached earlier this year. So a lot of cushion here in terms of interest rate movement. So as we have conversations with school districts in accessing the capital markets, I think it's beneficial to take a historic look and a historic perspective of where interest rates have been and where they are now. So while we've seen this volatility, a spike in interest rates, we've seen them stabilize, come down again, and issuers accessing the market in a relatively more stable environment, and accessing still at very low interest rates by historical standards. I'll stop there to see if there are any questions for Marcus and myself.
Well, I'm not seeing any questions or hearing Dave or Tom jump in. So we'll see. Well, let's go ahead. Dave, are you there?
Yes.
And I'm here too, Julie. The thing that that keeps going through my mind, and I was waiting to see if others asked questions, is with the uncertainty that we have of funding, thinking about what Dave said, and in particular what Dave said about you really don't count any money until it's actually received and in the bank, basically by the school district, and thinking on the general fund side, and thinking about what Bob provided to us in that the 1.6 billion that sounded like that was something that district should be receiving relatively soon. That's all very positive news. But districts that have the ability, so this is getting to my point and maybe the question, is districts that have bonds that they can sell and districts that have projects that are needed will certainly, if they sell those bonds and initiate contracts for those projects, will certainly start to stimulate the economy and get back jobs that were lost. But Erica, how many districts are you thinking or seeing in your work getting ready to do that? Is that something that districts are getting ready to do? It would seem to me that many districts, and in particular many boards, would be cautious and be conservative now when everything we're learning, and if those that listened to the webcast last week, that prices have stabilized and that contractors are sharpening their pencils and that there are more workers. So this seems like a wonderful time to initiate projects if districts were willing to sell bonds and sign contracts. So what are you seeing, Erica?
Yeah, definitely seeing school districts be cautious and asking the right questions in terms of, concerns with regards to the economy. Is this the right time? And I think looking at this historic perspective is helpful. But like you said, if districts are in the part of their capital improvement projects where they're continuing their existing bond program, have projects that are ready to go and be funded, it still continues to be a good time to lock in very low interest rates to fund those projects. And like you said, a lot of the conversations we're having is driven by the fact that these projects will help also stimulate the local economy as those are being awarded to local firms in the respective areas. But yeah, definitely having a lot more conversations with school districts, walking through their needs carefully, and also assessing where the market is and where interest rates are for the respective school districts.
Thank you for that. And one of the things that comes to mind is what Dave said a little while ago about having the state consider selling more bonds sooner.
Right.
What we experienced in 2009, working at the beginning of the recession, working with the Department of Finance and the Office of Public School Construction, there were more bonds sold faster, and they weren't getting ready to sell bonds, and they were convinced that it would be a good thing to do, and so districts were able to get state funds, and they needed their matching funds. My point is that if districts are willing to sell bonds, local bonds, and initiate projects, that gives us, in the work that we do, information that I think would be vital to say to the state decision makers. We have districts willing to sell local bonds and initiate projects. Can you back them up by funding their projects that have been waiting for funding for such a long time? That last part wasn't a question for you, Erica. I was just kind of making.
Yep, no, that was all great. No, I think that's all great information to share.
So Erica, there's a question here, which is, what's your opinion on the bond refinancing with the current market conditions?
And I'll ask Marcus to give his input as well, as he's in the market with bond transactions on a weekly basis. But a couple things. One, right, interest rates continue to be near historic lows. So that's if the economics of a refinancing achieve the goals of a local school district, we are seeing school districts move forward with refinancings. The one aspect I think Bob touched on as well is that with tax reform, that eliminated the ability of school districts to move forward with advance refundings on a tax exempt basis. So those have been moving forward on a taxable basis if it meets the goals of the local school districts. And the taxable market has seen its own set of challenges as well. So I don't know if Marcus wants to comment on that. We've seen the taxable muni market stabilize a bit as well from the onset, and folks moving forward with some of those taxable advance refundings. But I think important to keep in mind that if there is something on the horizon that may bring back tax exempt advance refundings, that's something to definitely consider. But Marcus, what are your thoughts on that?
Hopefully we still have them.
Oh,
Oh,
but again,
I think I was muted there.
there you
Oh,
go.
there you go, Marcus.
Yeah, in terms of the taxable advance refunding market, I think, you know, the taxable municipal market has been a little bit slower to recover. You know, we saw in the first, I'd say 3 weeks, starting March 9th, no taxable deals really get done, as there was a significant amount of pressure in the corporate bond market. That is the likes of Apple, GE, Google borrowing. And so rates in that market spiked pretty significantly as investors were concerned about corporations possibly not being able to pay back their loans. So many buyers in the taxable municipal bond market are those same buyers. So we saw, I would say, a lag of about 2 to 3 weeks where tax-exempt municipal issuance started to work again and investors were purchasing it, but we didn't see the same follow through in the taxable market. Now, just this last 2 weeks here in California, we've been able to do, I'd say, a significant number of transactions in the taxable space that have seen good reception. And again, really the big change here was, you know, about 2 weeks ago when the Federal Reserve started buying corporate bonds as well as part of their quantitative easing program. And so that lowered the spreads or the interest rates in the corporate bond market, and hence lowered rates in the taxable muni market as well.
And Marcus, the important thing for our listeners to understand is, if I'm understanding correctly, if I want to go and do a refinance, it becomes taxable because of the change in law, correct?
That is correct.
And those are specific for what we call advance refunding. So if your redemption provision for your existing bonds are more than 90 days away from your current closing, then that would be considered an advance refunding. And here's the kid bomb here, but so I think that's an important consideration.
Okay. All right.
There you go. So anyway, just something to consider in terms of advance refundings is that if your call date is a bit further out, it would be taxable under current law. But if that does change, then you know, prior to tax reform, advance refundings could be done on a tax-exempt basis under certain provisions.
All right. Thank you, Erica. Julie, I think we lost Bob. Did we not?
Yeah, his Wi-Fi went out due to a storm. So you can definitely tell it's a totally on the East Coast, not here on the West Coast. So I'm sure what we'll do, Dave.
I know that we're without him, and we're winding down. We just have a couple minutes left, but I thought it may be helpful to just kind of explore what Bob had talked about in terms of the funding that is, as he put it, is guaranteed to come to schools in California. And you and Dave were having the conversation about whether it was a split schedule, and we know what those things look like in the 80s and 90s and into the early 2000s, where school started early for some students and then started later for others, where they were on double session. And the kind of the discussion of trying to separate students reminded me of our discussions in the 1990s of class size reduction, and where in 1996, those of us that were around saw the state incentivize districts to go to 20 students to 1 in grades kindergarten through 3. And the state provided the following year $1 billion, almost $1 billion, as I recall, for classrooms. That kind of a perspective, building a classroom in the mid 90s, very different story than building a classroom today in terms of costs. So the point of my comment is that the kinds of considerations that districts would have to have before them are going to be expensive. And if they were thinking to move on modular buildings or portable buildings quickly, or even trying to go to split sessions, and as Dave was pointing out, costs there that are personnel costs and others. So these are things that we intend to explore in our future webinars, but really important questions. And of course, we want to look at when those federal dollars are going to come to school districts, and if indeed the state of California tries to give us certain directives as to what they see as a priority for those expenditures, if that's possible, if they have that authority.
So Dave and Tom, have you guys heard on any way that they'll likely have a formula for those funds that's going to come to the state of California?
My understanding, and I'll defer to Bob, unfortunately he's not on, is that the state will get the money and they're supposed to be primarily distributing it as the proportion of Part A Title I to the statewide Part A Title I. So it does not look like, if I remember correctly on the language, that the state would have a discretionary authority to just do an equal amount per ADA or something like that. That it will have the other type
And
of.
I'll just chime in really quickly. This
Say
is
again?
not my expertise at all, but I did. This is Erica from Stiefel. This is not my expertise, but I did see from school services put out a calculator that has an estimate for that distribution that I thought was useful if folks are interested in accessing it that way.
Thank you.
Thank you, Erica.
Yep.
Dave, this is Jeff. A question that has been running through my mind is related to SB 117, which gave us the relief on the ADA calculation for the current fiscal year. And you made the comment earlier, which I agree with, that students will return to school when parents are comfortable that it's a safe environment for their students to be in. And so that may mean that schools are continuing to do distance learning for a subset of their student population. Do you see going forward beyond the 1920 fiscal year any kind of flexibility from the state so that we can deal with that?
Well, the closest I can, Jeff, the closest I can think of is you still have the greater the current or prior year. I didn't think that had been modified. So if we can still use the amount of ADA that was used in for the current year, that should give some protection for districts going forward. The basic issue I think that you're trying to raise is the timing of the cash flow that districts might be seeing under the apportionment structure. Does it go back to the cash flow of 18-19, or will there be some different type of cash flow along the way? But as far as ADA, I thought we still had the greater the current or prior year and the 3-year averaging on unduplicated.
Thanks, Dave.
Well, Julie, we're at
Yeah.
12:15.
Oh,
Yeah, if I could make one comment,
please.
because somebody asked about California stimulus. We have, and I'm not sure if it's national, but I know in California at least, people were given an ability to defer making mortgage payments or making definitely rental payments. But I thought that was only a 3-month deferral. There may be something that people are going to look at through unemployment. So there's not some sort of a cliff where all of a sudden a lot of people are not making or are unable to make their payments, and that there is more foreclosures. So I think that is an issue that may be out there on the stimulus side, both on the federal level and the state level.
Yeah, it's interesting because if you think about it, the even though a lot of people aren't able to pay rent, the difference between rent and of course owning a home on the foreclosure, but those landlords that aren't getting the rent that they're still
Right.
trying to make payments on, especially the smaller ones who might only own a 1 or 2 homes that they're renting out. That's going to be
Right.
really
Yeah, and they may not be able to make their mortgage payments at that case. Similar to some of the people who owned either large malls or retail space that is now people not being able to make their payments on their retail rental.
right.
How that all starts playing around so you don't have a cliff creating a second round of layoffs.
Yeah, it just seems to keep morphing. But I do think it was interesting as Jeff and I, the 2 different counties. You know, if your county's in good shape and you're able to open back up, you've got low incidence of infection. You know, you just can't. Same thing. You can't look at California all with one wand of your hand of how to open back up. It's got to be areas that are able to open back up that do. It's just trying to get people not to move about the different counties to keep the infection rate low.
I think the governor will be discovering that it's easier to shut down than reopen.
Yeah. Oh, good point. Good point. All
Just
right.
as we're discovering that
Oh, yeah.
on schools.
Oh, yeah. We are dealing with some interesting issues as we think about what we're going to do with some of the restrictions that might be on us when we reopen. So
Yeah.
it's really challenging, but you know, we in school industry, we always love a good challenge, you know? All right. So as Tom pointed out, we are at the end of our webinar. So Jeff, Bob, Dave, Marcus, and Erica, thank you all so much for today. Excellent job. Just really great information. And I think you saw down in one of the chats down here that Bob is going to share his email so that if there's any questions that you'd like to ask him, and it's down in the chat box, and we'll make that available as well on the CASH website in the on the COVID-19 link. And our next scheduled webinar is Thursday, May 7th at 11 a.m., which will be a briefing from Sacramento, where the legislature and governor are taking California in the pandemic. So that should be as interesting as this one. This was just super today. Lots of information out there. So Cash and myself and all the presenters on the webinar today extend our best wishes for continued good health to you and your family. Cash will continue to keep you informed through emails and webinars as we learn more. Please follow your recommended healthcare precautions for your county. And I think this webinar truly showcases the absolute power and importance of the public education industry in keeping our communities going. And again, gratitude and thanks to all our essential workers and frontline heroes out there. In signing off, remember most of all that Cash is here to help and be a resource to you and everyone in maintaining our sanity and continue to operate during this battle against the spread of the coronavirus. So thank you all, and we'll be here next week. Stay Cash strong.
Thank you, Julie.
All right, thank you.
Thank you. Stay well, everyone.
Thanks, everyone.